information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
All right, everybody, welcome. So I do want to take a minute and just do a little self-promotion. So John G. Ullman has a YouTube page. We create lots of great content around financial planning and investment management. And I do a weekly content piece that really focuses on current events. So we do a weekly market update that looks at the economy and the financial markets. And most of today's presentation is going to be more about fundamentals, sort of core concepts that define investing and the relationship with the markets. Whereas in that piece, we do more current events, what's happening right now, what's happening with tariffs, what's happening with the tech sector, things along those lines. So with that said, what we're going to look at today is we're going to start with a discussion of the basics of investing. We're going to move into the relationship between the economy and financial markets. And then we're going to move into our Q&A portion, where essentially we will answer some questions that were pre-submitted and then open the floor for you to ask your questions. So the reason we created it in this style is because we have a lot of different skill levels and experience levels in the audience here. And so we know that for some of you, the beginning part is going to be things that you already know and have already known for a while. But for some, it may be their first introduction to the topics. So we'll do quick fundamentals here in the front end, and then we'll give you a chance to ask a more specific and maybe more advanced questions that are relevant to your own curiosities. So what is investing, right? Most people think the stock market when they think investing. We're going to argue today that investing is much more diverse and much more broad than just stocks, right? One of the arguments that we would make is that when and where you choose to buy your home and how you choose to finance that is also a form of investing, right? Stocks and bonds, of course, but also your retirement accounts, if you have a small business, how you spend money and how you grow or invest in that small business. Essentially, the concept of investing is using these different tools that are available to you in order to grow or preserve your wealth. And of course, the key component of that is the tools. And that's where for a lot of people, it may be a little intimidating and discourage them from getting into investing. But we're hoping that by the end of today, you will be less discouraged and maybe even a little excited about getting into the opportunities that exist in the investing world. So again, very core fundamentals. What is a stock, right? A stock is essentially a share of ownership in an institution. So if I buy a share of Apple stock, I am literally a partial owner of the company of Apple. I can attend the shareholder meetings, I can vote on decisions that are being made and how Apple is operating. Now, keep in mind, if I own one share, there are folks in that meeting that own millions of shares, so my voice is very, very quiet. But I have a voice, right? It also means, to some extent, I'm entitled to the profits and the success that that company may have, right? A lot of times we think of this, or we use the term dividends to represent the profits that the company has generated that they then share with their shareholders, right? The catch to a stock is that you are a partial owner, and that company is going to, at least in theory, share some of their success with you, but that company has no obligation to share that success with you. They could choose to pay dividends, they could choose not to pay dividends, right? And there's no guarantee that the money you paid to acquire that share will come back to you, right? Hopefully it will. It's possible that the value of the share will rise over time, and that's always the goal. But there's no guarantee that that's going to happen, right? You could think of this, owning a stock, as a world of possibility, but also a certain level of risk that comes with that as well. In contrast, on the other side of the investment portfolio, we have bonds, right? And we tend to use these terms together as if they're a bundle, but bonds are very different. Bonds don't entitle you to any profits that that company may generate. Bonds don't entitle you to any ownership share or any voice in the operation of the company. Bonds are just a loan. If I bought a bond from Ford Motor Company for $1,000, I've essentially loaned Ford Motor Company $1,000. In return, they're going to pay me interest over the life of that loan, what we call the maturity of that loan. But then at the end, they're going to pay me back, and they have no further obligation to me in any way. Once they've paid back their loan, our relationship is ended, right? I don't have a voice in how they operate, and they don't necessarily have an obligation to share their success with me, aside from paying back their debt. So stocks and bonds operate in two very different ways. The stock has a little more potential, accompanied by a little bit more risk. The bond has a guaranteed return, the interest rate that's paid, and a guarantee that the principal that you've loaned will be repaid to you. But the potential is not there. You don't have an opportunity to possibly exceed that interest rate or do exceptionally better beyond what the original agreement is. So bonds tend to be considered a little safer and have a little less return in terms of the interest that's paid, whereas stocks are a little riskier, but also come with a larger range of potential outcomes, hopefully in a positive way. So where do people buy and sell these different securities? So most of the trading of bonds and stocks and bonds occur on exchanges, which are essentially centralized locations where buyers and sellers know that the other side of their transaction will be, and they can meet up and engage in these transactions. So the most famous one, and in fact the largest one in the world, is the New York Stock Exchange, right? But as you can see from the chart, there are stock exchanges all around the world, right? The largest ones happen to be in the US, but not the only ones. So one other question we might ask is, if I want to trade in these stocks and bonds, how do I keep track of how well they're doing? How do I know if the market's going up or the market's going down? So one way that we simplify this process, because there are thousands and thousands of different companies and governments involved, is we create indices. We create the Dow Jones Industrial Average, the S&P 500, the NASDAQ. These are three of the most commonly known indices, and they each basically represent the performance of a certain group of companies, specific companies. So the Dow Jones Industrial Average is made up of 30 of the larger companies, what we call blue chip companies in the United States. And it's designed to be representative of how large companies within the US are performing. The S&P 500 is comprised of 500 companies. It's a little broader, it's a little more all-encompassing, but the design is to capture the US market in general, not just large companies, but how are US companies performing more generally. The NASDAQ is an index that's designed with a focus on technology. So it's made up of thousands of different companies, but all with a general technology-related business or business goal. So we tend to look at all three because they each capture and represent a different part of the market. So you may see on any given day, the Dow Jones may go down 2%, and the S&P 500 may go up 0.5%. They don't necessarily move in unison. There are days when they do. When the market itself is doing well, all three indices may be up. But on other days when there's mixed results or specific companies that are having good or bad results, you may see some variation. So if we move more into the individual perspective, as you are thinking about making investments, there's a wide variety of questions you're going to want to ask yourself, or you may want to talk to your advisor about in your investment decisions. So one of the first and most important questions is, what is the length of time you're looking at for this investment? This could mean two things. It could mean, how often do you want to change the investment? How often do you plan on going in and changing how your money is invested? Are you going to be watching it every day? Are you going to check it every 3 months? Are you going to put it in there and not look at it again until you're ready to retire, right? This question of how much you're going to engage with your investments might actually change how you invest. But at the same time, your question might also be, when do you need the money, right? How long is this investment going to be invested, growing and preserving that wealth before you actually need to use it in some capacity? So it may be that I want to invest some money so I can save up for a down payment on a home, right? This investment I might hope to get there in less than a year. And so what I'm going to think about in my investment choices is I'm going to think about places where I can get a good return, but maybe not put that money at risk. If something bad does happen and I need that money a year from now, I don't have a lot of time to recover any losses that may occur. So I may be a little more risk averse and a little safer in what I invest. Whereas if I'm looking to invest for retirement, I may instead be looking for a very long-term profile, and I'm willing to take a little bit more risk because if bad things happen, I've got plenty of time to recover on the other end, right? So some other questions you might want to ask when you talk to your advisor or you look at your investment portfolio is, what type of investments do you want to focus on, right? First and foremost, one thing that I want to mention is that investing can be as simple and as hands-off or as complex and hands-on as you would like it to be. You could imagine a world where you just set up an automatic deposit that goes into an index fund every month. It happens without you having to be involved. You don't look at it, you don't think about it, and it just grows, right? Or you could look at a more nuanced and maybe more complex investment environment where you may want to actually work with an advisor or work with someone who has some expertise in what you're investing in. And it may be an environment where you're making regular trades. You're looking at each individual holding. You're changing how much you hold. You're changing how long you hold it. You may have target prices for when you want to get in and buy or when you want to sell and get out. But the investment world is a la carte in a sense that you can make it as simple or as complex as you would like it to be. So some of the things that we focus on in our investment portfolios is, are you looking to grow your money in what we consider a growth style of investment? You're looking for a company with lots of potential in the future and will hopefully grow in value very quickly. Or are you looking for a value investment? Are you looking for an opportunity where maybe a company is doing well, but the rest of the market hasn't recognized it yet, so the price is lower than it should be based on their actual financial performance, right? This distinction between growth and value is a really important one and a major one in most investment portfolios. You may also think, what size companies do I want to look at? So in the market, we refer to this as small cap, mid cap, and large cap. And it's just telling you what size that company is. In terms of their financial performance, how large is the company? As you might imagine, large cap companies tend to be a little bit more stable, so there may be a little less risk, but your range of potential returns may also be a little smaller because, again, they're more stable. They don't have 1 month where they're up 100% and 1 month where they're down 50%, right? Small cap or smaller companies tend to be more volatile, right? They tend to be more sensitive to economic fluctuations. They tend to have a little bit more risk because of that volatility, but they also have a wider range of potential outcomes, right? So with John G. Ullman, one of the things that we do is we use an active management style and a balanced portfolio. So what we try to do is we try to capture a little bit of these different aspects of the investment portfolio in a very balanced way. So we have some investments that are a little more aggressive. We have some that are a little more conservative, but we try to make sure that our clients' portfolios capture the best of all worlds, right? Hopefully, the best gains and the minimum risk that we can create at the same time. This brings us to the next piece. When looking at your investments and when looking at your financial balance sheet and portfolio in general, diversification is incredibly important. In fact, investment, I would argue, is very easy. With the apps that we have, with the tools that we have, with all the investment firms that exist, it's very easy to put money in the market. It's also very easy to lose money in the market. What diversification really is just risk management. It says, let's make sure that we invest this money in different places, in different ways, so that if something bad does occur in one place or with one company, it doesn't harm our entire financial future or disrupt our financial goals. So you could look at diversification in your portfolio, meaning you have some growth stocks and you have some value stocks, you have some small cap and you have some large cap companies. But you could also look at diversification within your financial well-being and your financial lifestyle. If I work for Corning, I don't want my entire investment portfolio to be made up of Corning stock. If my income is tied to this company, I don't necessarily want my financial portfolio also tied to the same company. I want to make sure I diversify and spread that risk around a little bit, right? Unfortunately, when it comes to risk management, there's no way to eliminate all risk. So instead, what we have to try to do is make smart choices and minimize as much risk as we can, minimize the impact that any one disruption may have. So I just glanced at my watch and realized that I have definitely gone a little over my allotted time. Mark was kind enough to leave me this last slide. As an economist, I will tell you that I absolutely love supply and demand. I would argue in anything that you do in the world, if you can understand the supply and the demand for that product or that environment, you can understand what the future will hold. If you understand the demand for oil and you understand the amount of oil that's available, you can very accurately predict what the price of oil is going to do in response to those things. Now, I don't want to oversimplify it. Understanding the demand of millions and billions of people and businesses is difficult, but supply and demand of essentially stocks, bonds, of anything that exists around us will help us understand our investments as well. If I understand an individual company's demand for their product, I also understand the supply of the materials they need to make that product. I understand the supply of workers they have to operate their factories. If I understand these two sides of the market, I can pretty accurately predict what the future in that market may look like. With that said, I am going to get out of here, step off my podium for a minute, and give the platform to Mark.
Thanks,
You
Mark.
already have a mic? Absolutely.
Yeah, I got a mic. Yeah, thank you.
Excellent.
So thanks very much, Mark, for explaining the market, bonds, stocks, also supply and demand. In the economy, you have a cyclical economy that's very much corresponds to supply and demand. When demand is increasing for economic goods, we have an economic contraction. Generally speaking, the economy over time trends upwards in terms of gross domestic product, but in the short term, it's very cyclical. And the economy will expand, reach a peak, and then turn down, generally speaking, in a cycle, somewhat like a sine curve. And then eventually the economy will contract, reaching a trough. And the time to invest really in riskier assets is during the trough of the economic cycle. The time to sell riskier assets is during that peak of the economic cycle. So you can really time your investments in line with the economic cycle that we see. Of course, predicting the economic cycle can be very tricky, right? If you can tell me where the economy is heading next year, the year after, and the year after that, please come talk to me after this lecture, and I'd like to pick your brain, because you could make a lot of the correct investment choices if you could time the economic cycle. In terms of contraction, if the economy contracts for 2 consecutive quarters, we call that an economic recession. So there's a lot of focus on when the next recession will happen, and there are leading economic indicators that could point to that recession. The last recession we had was in 2020 due to COVID, and I looked it up this morning. 24 million Americans lost their jobs in 2020 due to that recession. The recession before that was in 2008. That recession was called the Great Recession due to the fact that it was long and a lot of people lost their jobs as well. And it came from the financial crisis that was due to failure to pay mortgages. And that was correlated with the subprime mortgage market, which we won't get into today. But essentially, it was a financial crisis that led to a recession. At the time, it seemed like it was the biggest recession, in fact, since the Great Depression. That was, before that, we had a recession in 2000. That was due to the dot-com bubble bursting. In the 1990s, we had a long period of economic expansion, but dot-com bubble burst. There was a lot of investments that went into technology. The technology did not pay off the way it was predicted at the time. We saw a correction in the market and the economy. In 2000, we had a recession due to that dot-com bubble. The one before that was in 1990, and that was due to an oil price shock that we saw in 1990. And then in the early 1980s, we saw the Federal Reserve increase interest rates to combat inflation, and that led to a couple of recessions in the early 1980s. So you see throughout time, you have periods of economic expansion and shorter periods of economic contraction. We call that the economic cycle. And gross domestic product is one way of measuring economic output and that economic expansion. And we see 70% of GDP comes from the consumer. So the remainder comes from government spending and business investments. It's really the consumers that are driving the overall economy. So when consumer sentiment is poor, that could be an ominous sign for the economy going forward. If consumers are leveraging and taking out loans and spending, that could really drive the market as well. In terms of nominal GDP last year, it was in the United States, it was $29.7 trillion. It's the world's leading GDP, and it's up a lot from the 1990s, where it was below 10 trillion at the time. So we see a decent amount of growth in terms of GDP over time. That's very much due to economic expansion over time. During periods of economic contraction, we'll see the unemployment rate jump up. And the unemployment rate right now is at 4.2%, with 7.1 million Americans unemployed. Now, the other key economic number when it comes to the labor market is the participation rate. And that is out of the entire working age population, how many are participating in the labor market. That right now is at 62.5%, which is a steady number, and it actually signals a healthy labor market. So in terms of the overall economy, it signals a strong economy that comes from a strong consumer and a strong labor market. And as I mentioned, the consumer makes up 70% of GDP, so a lot of attention is given to the health of the consumer and how much they're spending, and also how much are they saving. If they're hoarding cash, they may be anticipating a recession themselves. If they're spending, then that would lead to economic expansion, given that businesses have to produce more just to meet the consumer needs. So this is something that's really gets a lot of attention, and that's a key monitoring point for us: consumer spending and saving, and also consumer sentiment. Now, the other key number that for the economy that the Federal Reserve looks at is the inflation rate. So the Federal Reserve, being our central bank, will look at the unemployment rate and also the inflation rate and set policy based on these two key numbers. The inflation rate can be measured by the Consumer Price Index, which measures the change in price of a basket of goods and services. And we have a pie chart here that breaks down the Consumer Price Index components. That largest slice at 44% is housing. So when you hear about inflation going up, it's a lot of it is the price of rent, or if you own a house, rent equivalent going up. So if you're renting right now and you see that rent prices go up, that will lead to higher inflation rates. The other key components are, so there are a handful of them, but the two big ones are transportation. Transportation makes up 17% of the consumer price index. So if your car payment is going up, if your gasoline payment is going up, that will lead to a higher inflation rate. And also food and beverage, of the prices you see at the grocery, if they're going up, that will lead to a higher inflation rate. So this is how we measure inflation, is through this consumer price index, which is a measurement of the average change over time the prices paid by consumers. So what is inflation? Well, in summary, inflation is an increase in prices that consumers pay. If you see that your salary is stagnant and prices go up, that means you have lower purchasing power amount, right? Your level of purchasing power has declined in a high inflationary environment. So it's something that gets a lot of attention from the markets and from investors and from the U.S. central bank when they set their monetary policy. So setting monetary policy, you can see this slide right here. Essentially, one of the key tools the Federal Reserve has is the federal funds rate, and that's the interest rate they charge to other banks that then in turn charge to us. So when they want to slow down the economy and reduce that inflation rate, they could increase this rate. So essentially, they'll say, if prices are too high, there's too much demand out there for the goods and services in the economy. If we raise the interest rate, well, it'll be harder to borrow and purchase that next car. It'll be harder to borrow and purchase that next home. It'll be harder to borrow in general, right? So with that, you take off a little demand, and that helps balance prices with demand and supply. So that's one key tool that they have, is to increase that interest rate that they charge to other banks, and essentially increase interest rates across the board. And that's how they set what they call hawkish monetary policy, hawkish against inflation. Now, sometimes when the economy isn't doing well, when unemployment increases, they have market-friendly policy, which would be to reduce interest rates. When they reduce interest rates, then you're more likely to borrow and buy that car. You're more likely to borrow and buy that home. So they really help change consumer behavior through this monetary policy tool that they have with the increase and decrease of interest rates. Other tools that they have is purchasing mortgage-backed securities and treasury bonds. They could go out and actually buy the bonds. That's really how they impact longer-term rates. After the Great Recession, there was quantitative easing 1, 2, and 3, and that was all essentially the Federal Reserve increasing their balance sheet, purchasing bonds, and that would increase the price of the bond, lower the yield on that bond. Essentially, they were trying to lower long-term interest rates within the economy to help stimulate the economy. So in terms of monetary policy, they'll try to stimulate the economy in periods of economic contraction to get the economy going again. When inflation gets too high, as we saw the other year, they'll try to hold back the economy and reduce economic expansion to help bring back prices to a more moderate level. So they're looking at those two numbers, the inflation rate and the unemployment rate, when setting monetary policy. And the other major government policy is fiscal policy. And this is the federal government deciding how much to spend and how much to tax. This is probably what you read about in the news right now in terms of the budget that's out there. Last year, we had a fiscal deficit of $1.8 trillion, meaning the government spent $1.8 trillion more than it received in taxes. That's at the federal government level. In fact, last year, the federal government spent $6.8 trillion and taxed about $5 trillion. So that gap is the fiscal deficit, and that's very stimulative to the economy. That helps drive the economy forward when you have a lot more government spending than tax collection. So in terms of economic theory, the government is really supposed to stimulate the economy during periods of recession, right? When we had COVID in 2020, we saw a lot more spending at the federal government level than taxes collected, and they're supposed to really tax a little bit more and spend less during periods of economic contraction. They're supposed, in terms of economic theory, they're supposed to let the free market drive the economy. But in terms of policy, that's not always the case. Oftentimes, they spend more than they tax just because that's more popular to do, and those budgets are easier to pass. And so, over time, we've seen a very stimulative policy in terms of the fiscal policy that's out there. And the problem is that the government's debt level increases over time when they're spending a lot more than they're taxing, and that can lead to problems in the long run, right? So in terms of expansionary policy, that's the government spending more than they're taxing. If they did have a contractionary policy, they would tax more and spend less. More recently, we've seen a large expansionary policy, and we haven't had a balanced budget in a long time. So those are the drivers of the market. Now, Mark and I, we also select stocks, right? We decide what stocks to purchase, and a lot of that is based on the specific company performance of that stock. So that could be the guidance that's coming from the management team. It could also be the earnings per share and the estimates of earnings over time, and whether the company is in fact beating market expectations or missing expectations. If the company's outlook is very good and they have an earnings per share estimate of $5 for the quarter for that company, and it comes in at $4, well, investors can be very concerned, and you can see the stock price decline. So a lot of our focus is analyzing the earnings per share from the company and seeing whether outlook is being increased or decreased, and seeing whether they're beating or missing in terms of their expectations. We can make investment decisions based on that. Of course, we also have to address global events and geopolitics, which I'm sure you've all read about in the news, and that can add to uncertainty around those investments, right? So we have to factor in geopolitical events and most recently the tariffs that we're seeing. We see right now that there's 10% tariff on the entire world, which is a large number in itself, that 10% rate, but there isn't very much larger number on China, and that tends to get the news. The tariff amount on China, it started off at 125%, then went to 145%, and there's stocks of 240%. So there's escalation in that tax, that import tax that would come from the goods from China. China is the second largest GDP in the world after the United States, and that's followed by Germany and Japan. So this trade policy does add risks to investments in general, and that's something that we very much monitor in terms of what the latest policy is and how it will impact the economy and also the markets. In addition to the tax on imports, we also have to weigh the supply chain disruptions. So China, they export some key minerals and some key components that go into electronics and the automotive industry. They're very good at making magnets and exporting that. So if they don't supply that, that could be a disruption in the supply chain. So even if we want to manufacture here in the United States, we still need some key minerals that may come from China, and that's an extra risk that we have to analyze when we make stock selection decisions. In terms of the overall market, we have generally a bull market during the periods of economic expansion. We have a bear market during periods of economic contraction. And it could also signal an economic contraction. So if you see the stock market sell off today, it could signal that the economy is going to contract within the next year, right? So when the economy is doing well and the market's doing well, we call that a bull market. When the market is contracting, when you see this market sell off, we call that a bear market, and that could impact valuation. It could impact market psychology, right? So when times are good and investors are really optimistic about the market, they may pay 20 times earnings for a stock, where when they're pessimistic about the economy and the future of the market, they may only pay 10 times price to earnings for that same stock, and we call that a reduction in valuation. So there's a lot of behavioral finance that goes into it as well. Sometimes you have this fear of missing out that can lead to bubbles. And there's also a fear of taking losses. People don't like to take the losses because of that feeling that comes from it, that you've lost on the stock. So they may take more risk on a loser than they would on a winner for that stock.